I'm going to just go ahead and start while we all sit down. I'm John Fiorelli. I'm a partner at Kenetic. We began in 2016 based in Hong Kong, one of the oldest investors in blockchain and crypto in Asia. We make investments in L1s, AI, DeFi. I have the privilege of moderating this panel today on RWA tokenization, which often gets treated as one category, but it's not really. It's a stack, isn't it, right? And so we have a panel of speakers who represent several of those layers. You know, you need someone to provide a platform to issue tokens compliantly. You need folks to originate and curate. You need folks to provide investment and capital into those ecosystems. So we have a terrific opportunity today. To my left, we have Conor Moore of USD.AI, mentioned in the previous talk. He basically is helping to originate RWA tokenization for AI, and currently has about 1.2 billion in approved facility now. Really impressive. To his left is Bhavin Vaid of Birch Hill Holdings. They are originators as well. They're backed by Parify and Castle Island as well. Nice. To his left is Chen Shanlong of XDC Ventures. They're investing about 125 million into RWA projects for the XDC network. And to his left is Edwin Mata, who is of Brickken. Am I pronouncing that correctly?
Perfect.
Is a token an issuance platform. I'm going to ask each of you to give a quick intro. I'll start with you, Conor.
Sure. My name's Conor. I'm co-founder of USD.AI. We started this company back in 2021. Before that, I was working in traditional finance, investment banking, private equity. We have spent really roughly 5 years now trying to build structured credit products on chain. We tried a wide variety of collateral types before we really found an area that could basically meet the borrower side needs and adverse selection problems, and ultimately be attractive to on-chain capital. And that was within this very specific niche of financing GPUs for AI CapEx buildouts. And so over the last 2 years, I've really focused entirely on that vertical. And today, we've certainly started to find the beginnings of PMF, I think, in that vertical. I think USD.AI as a concept of on-chain financing for a specific asset type that has problems as why it can't get capital through traditional rails is compelling and has kind of found its fit in the market today. So today, USD.AI finances, or at least looks at most of the kind of sub $200 million cluster deployments, and basically originates loans and then rolls those loans up into a traded debt instrument on chain. And the presence of that secondary market liquidity to be able to trade in and out of that instrument, in addition to the presence of primary market redemptions from these loans paying down over time, gives a liquidity profile that's attractive to the capital markets and generally is not available otherwise. There's no ABS market for GPUs because they depreciate quickly and these are short-dated loans. So that's basically the niche that we play in today.
Hey everyone, I'm Bhavin Vaid. I similar background to Conor. I started my career in investment banking at Goldman, originating real estate structured credit. From there, I went to Cerberus Capital on the real estate PE and distressed debt investing side. I spent the 5 years after that as an investor in the digital asset space, more on the equity side of things. Start first at 10T Holdings, a growth equity fund, and then started my own fund in the space. Birch Hill really, I think, is the encapsulation of my entire career. It's bringing some of the discipline and lessons that we've learned from traditional real estate credit origination and understanding what does a net new iteration of that look like in on-chain securities, and helping institutions now originate assets as well as helping set up markets on platforms like Morpho and eventually expanding to places like Euler as well.
Yep, hi, my name is Shanlong. I work for XVC Tech, which is a $125 million fund from XDC Network, which is an L1 blockchain. and it's EVM compatible. So, like a few weeks back, I think we announced the onboarding of HashKey as one of our institutional blockchain validators. And over the course of Consensus Miami, I think we'll be unveiling another 2 institutional validators as well. So keep tuned.
Hello, everyone. My name is Edwin, the CEO and founder of Brickken, formerly an M&A lawyer, and then I started Brickken, which is a tokenization as a service company. So we provide a full stack, abstracted for any asset owner company to be able to deploy whatever financial instrument they do it on their end. So we're always worrying about servicing a great technology that really penetrates the market by evading all the complexities with tokenization and it just being capital formation or whatever they want. We have service right now we have crossed over 200 live clients in 30 different countries. Our platform has been used for tokenizing 500 million. And yeah, the space is growing definitely. Happy to be here because tokenization has become more like a proof of concept into actually a practical concept. And I think this year we're seeing a lot of private creators jumping in. And yeah, happy to be here with my fellow speakers.
Thanks, Edwin. Conor, you used the term PMF. I think that's a great, transition into our first question. We have about, 30 billion? A lot of it's in treasuries. Where else is this working? Where are we seeing PMF? Where do you foresee new PMF coming? I'll start with you, Conor.
Yeah, so we have the benefit of having tried a bunch of other asset types that didn't work for a variety of reasons. So before we landed on this vertical, we started this company in 2021. So we did NFT lending, gold bars, DePIN assets, watches, land, a lot of stuff. And I think the reality is that within anything that is using crypto rails, you have to be not only accessing capital that's not available to the borrower base, but you need to be unlocking asset types that are structurally walled off from access to capital generally. And I think this is not going to be the case in the permanent kind of steady state. But today, the only way that you can convince a borrower to, access capital from crypto rails and not also be just like taking on some sort of adverse selection where they're coming to crypto because they can't get approved from a bank. The only way to do that is if you are unlocking some asset type that can't get access to capital otherwise. And so, or there's just like structural reasons why they benefit from accessing your capital. So in the case of the GPU financing, it's pretty straightforward. It's a brand new asset type. Crypto markets are pretty open to new asset types as sort of like a standard. Everyone in crypto is pretty cutting edge in risk taking, and so for us to finance GPUs using crypto dollars, the capital is there, and it gets the thesis. And in a lot of ways, GPUs and burning electricity to turn into compute for the purpose of running LLMs is not crazily dissimilar from ASICs and Bitcoin mining, and that vertical obviously had its own debt market and so on within crypto. So I think those are the types of opportunities that are going to be most compelling until you get to a point at which you can attract capital without it needing to be just like true on-chain capital. And maybe that comes in the form of raising funds who raise from traditional investors, and then those funds go through crypto rails, but it's a little bit abstracted away. So those are at least where I think the lowest hanging fruit is for tokenizing efforts. And there's companies like we talked about that are doing this as well.
And your focus is on inference. Why is that good for? Why is crypto and RWA good for GPUs for inference?
So there's two things. So there's like the whole DePIN ecosystem. So you have this concept of decentralized inference and training, where you can plug into a network, and then that network can run in a decentralized format these, turn on these GPUs and have them spit out tokens, which then a consumer can use for their, hidden API to deliver a product. But I think generally, the reason why crypto is good for this type of financing is that it really needs a secondary liquid debt market to be able to support. So if you think about Fannie and Freddie, the reason why the mortgage industry in the United States is able to operate so efficiently is because nobody's holding that on their books. And as soon as you have to hold something on your books, that represents illiquidity, and that illiquidity charges a premium. And so if I can, to my capital source, to the minters of SUSD.AI, if I can have them be able to trade out of that instrument tomorrow, then that means that they have a lower required return threshold for something that would otherwise be deemed illiquid. And so that's really the benefit of doing this on chain, is you have this traded debt instrument. SUSD.AI, which today is only about $350 million notional, has traded over $12 billion since launch.
Gotcha. And that's a great transition to Bhavin. I mean, Bhavin, you're focused on curation, on Morpho. What do you see that's achieving PMF? Because protocols like USD.AI need folks like you to really drive that. What's working?
I think one of the big things curators are starting to do pretty well now is really taking a hard look at NAV and what is an accurate NAV and what NAV should you be lending against. A lot of times with on-chain assets, it's the originator themselves self-reporting their NAVs. As we're seeing in the public markets with things like BDCs trading 40% off NAV, or these big dislocations of what groups are reporting value is and what people are actually willing to pay for it. I think an interesting thing that Steakhouse, one of the curators in the market, and something we're doing on our first market, Groma, is we are setting a discount to the actual NAV that's being reported, and that's the NAV we're lending against. Over time, the idea is to lower this discount. The discount will only go down. We're not going to toggle it up ever. And so the idea is to start it at a big enough discount, and over time season it. And I do think that is the approach that people are going to need to take to get around some of the adverse selection stuff of bringing not accurate NAV reporting on chain.
So this isn't points like incentives, right?
No, not points like incentives.
I'm just teasing. This is a good segue to Shanlong. Shanlong, you've been doing a lot of investments, specifically in projects that are supporting XDC, and kudos on USDC being on XDC. What's working for you guys on XDC?
Okay, for us, I think we have a very interesting approach itself. We recently acquired a firm called Contour Network, which is more in the area of trade finance itself. We've also invested in the likes of RWA, which is a portfolio firm from Stanchart Ventures itself. And quite recently, I think in Q1, before the missiles started to fly, of course, we invested in a firm called Compute Labs, which of course I'm sure works very closely with USD.AI itself. I think for us, we wanted to find an angle when we invested in Compute Labs, to give people exposure into AI on the blockchain itself, but it's a different slant from investing in private equity of the likes of Perplexity and Anthropic. We wanted the users to actually gain yield which is higher than the norm from your typical money market fund itself, because for AI, as mentioned, the GPU financing the chips, they actually have a relatively short shelf life. Hence, the yield which you are able to get is usually north of 20% itself. Yeah.
Okay, great. Edwin, as a tokenization platform, what are some of the either areas that you're really focused on where you think PMF is possible in the next 12 months?
Yeah, so we don't focus specifically on a client, but I can definitely say what we see working and getting raised, because obviously everybody has a great idea and they want to raise capital without really understanding the fundamentals that not everything tokenized gets free money, right? And that's the misconception we've been fighting for years. It's just because you put something on chain doesn't mean you're going to attract liquidity. So you really need to push that the yield is the product. It's not sometimes the asset. Sometimes they don't even care about the asset. It's how much am I going to rating? What is my lockup period? What is my redemption? So they're acting like true finance, right? So what I believe is that all private credit and debt makes sense. Private markets on equity, not yet. We're way behind that. So public markets do work. And if you want to hit private markets right now, everything that is debt issue, short term, maybe 90 to 120 days, because people are used to very highly liquid, and that's a problem that Web3 people are bringing to TradFi because everything is T0. So I think there's right now everybody trying to understand what is the best product out there, and we've seen a lot of vaults being built on top of that, or tokenization on credit and debt. So I think over these like 2 years, we're gonna see that everything that is quick, fast, efficient, high yield is gonna work, and that's kind of like the unicorn because everybody wants to do that, right? So on my end, whenever we see a blue chip that we call internally, it's kind of like that provides insured, that it's audited, that has high yield. We start moving it around with some curators, distributors, and it's like, hey, we have this high product. Do you want it? And people are going crazy. Even with the crash with Aave, like our email got spammed. They're like, okay, we know that DeFi has all of these things. What do you have on private credit? And that's what we started saying. It's like, we have here an opportunity that people are like early stages of understanding all of this on fully on chain, and the NAV becoming also kind of like all the data points working because it's digital native to issue debt on chain. So I think it's going to be a very interesting year. And personally, I'm super excited about debt, which is horrible, right? To be in debt, but everything is on debt. So
It's okay, we forgive you. Look, I think you're transitioning into a question that we're all asking ourselves, which is, private credit's about, 8 to 12% traditionally. On-chain credit is promising 8 to 15%. If there's a premium, where's that coming from? I mean, what? I'm going to throw it out to who wants to answer that first? That's a tough one, huh? No one wants that one first. But Bhavin, I'll ask you because you're doing a lot of origination. Where do you think that comes from?
The premium on chain?
Yeah.
I think right now it's being miscategorized potentially. A lot of it's token inflation.
Yeah.
And I think how there's a new methods, I would say, of how people are reporting this token inflation, especially for tokens that are not released yet. They're saying, assuming a launch value of X FDV, fully diluted valuation, your actual yield maybe would be 40%, 50%. In reality, maybe that launch happens at 50 to 75% lower than where they have anchored at for the APY number you're seeing. And so it's just reading the actual fine print and the details of what you're actually investing in, which candidly, to your point earlier, people are just looking at the spot headline yield and depositing. And I think it takes having 5, 6+ years in this industry, getting burned a couple of times from being a part of it long enough to be able to know what to look out for. And I think it's on people like us as curators to, I would say, educate the market about what that actually yield can look like.
Yeah, I think it's like super nuanced because you have the I'm launching a new thing and I'm incentivizing that thing and those yields. And you could find a new thing launching every month and kind of take that as your top line, like, oh, this is what the yields are, and that's what's high, and that's what attracts kind of that mercenary capital to come in, right? But then you have the sort of like blue chips. Like Sky and Maple and these guys who have been around for a while. And if you look at, you can see all of the yields for all these products. In most cases, those yields for Sky or Maple or others that are quite large are actually pretty low. They're like maybe mid-single digits. And so that, I think, also makes sense. So it's like at the beginning, you have higher yields because of inflation and incentives, which is a fantastic thing to bootstrap, a new product. And then you have lower yields than maybe you would see in the private credit markets. And those lower yields represent the presence of liquidity for those products. And that's like where you would maybe split those two categories out.
Any other thoughts?
Yep. So as mentioned, for XDC, we invested in Compute Labs, and I think the main reason is because their APY is usually quite comfortably, sometimes even as high as like 30 to 40%, depending on the lockup period itself. So, but for us, I think we have different products which cater to different markets per se. Like for example, for retail, 30 to 40% might be something which could be of interest to them. But yet for institutional, folks itself, 30% or even north of 20 usually would freak them out. So I think sometimes like we deliberately have a lower yield, like even for our Compute Labs products itself, but we layer on things such as CoFast insurance itself to like as a security on the GPU chips which are being financed as well as the data centers, so that to make it more palatable to the institutional folks, because like the fact of the matter is no one would want to invest no matter how high the APY is, at the risk of potentially losing their job.
Can I add to that? I think one thing interesting you said was the lockup that you can do, where you're starting to see now duration-based yield opportunities, where people are getting paid higher for actually locking up their capital, which for a long time, I don't think that was priced accurately potentially on chain. And you're starting to see even that last chat with Maple where they're talking about having a senior and a junior tranche for yields. I see these private credit, traditional credit mechanisms porting in the digitally native way. It's not totally skeuomorphic. There's like some nuance to how we do it, but it rhymes.
I just would like to add that we should also price in the efficiency of the technology, right? I mean, there's a couple of bips there that you can actually offset. And I'm going to put an example of a client who is providing higher yield to earn liquidity, but in the end, he's like going to start reducing it. But this is the first attraction where he doesn't want to, like, he's going to provide more earnings just to start attracting that pool of liquidity. And then he's going to start averaging down. But at the beginning, it's like, okay, so I'm reducing these intermediaries. The on-ramp off-ramp now gets cheaper. So I'm going to provide higher yield. And it's also kind of like a way to attract capital, because this is kind of like everybody's trying to understand how the liquidity is going to start arriving to a pure on-chain rail.
I think, a good segue from that is, we've been talking about when institutional capital for a long time. I've been in the space since 16, and we've been talking about this for 10 years. It's been fun. I think the question I have is, I'm institutional capital. Is this a good place to play? Why do you guys think it's a good time to do this? And why should I deploy with size, given what you just said and the risks? How should I look at this from a risk-adjusted standpoint?
Well, I think in steady state, this is a more transparent financial instrument than what you would get elsewhere. So, for example, with our product, every single 30-day principal and interest payment is made on chain. If a payment is missed, that's visible, and you can see that. And I think the benefit of building everything from a first principles digital version is that you can ultimately have very, very transparent products that at a granular level, nobody's going to check every single one of those things. But now you can have a DeFi llama or some kind of research group to be able to go and check that stuff and just publish it all publicly. So I think the transparency is a huge selling point. The liquidity is a huge selling point for things that are otherwise illiquid. And then you do have the ability to both play in the kind of stabilized, section of the market, but also, go and get these governance tokens and participate in incentive, programs and so on. I think that most likely the format that institutional capital comes on chain is through a fund or otherwise, so somebody else is doing it on their behalf, and then they're allocating capital that way.
I'm going to do a quick follow-up there. From a legal perspective, things break. There's restructuring all the time.
Yep.
So what's the legal framework that you're relying on to make me feel I have recourse?
So we have a very complicated legal structure for all of the loans that are going through USD.AI. But fundamentally, it looks and feels very similar to any asset-backed financing. So you have a bankruptcy remote SPV that holds title to the servers, as well as the contracts and the bank accounts that are associated with that pod. The benefit that I have is that these are very modular deployments. Like a standalone cluster of GPUs in a data center can ultimately be owned by you or owned by me, and they're kind of the same operation. It doesn't really matter. So that's very beneficial for us. But ultimately, what we do for our product is we have NFTs that are named in our loan agreement. And those NFTs basically are given legal rights by way of being part of this loan agreement. And that is what's being put into the actual smart contract that is being represented on chain, and ultimately is what USD.AI, the tradable debt instrument, is referencing as a fractional ownership of.
Gotcha. Bhavin, you're working to originate, and you're talking to institutional capital. I'll go back to the previous question. Why should I scale into this space? What do you tell institutional capital now?
I think piggybacking off what Conor said, I think the allocator space on chain at scale today are the stablecoin issuers, mainly the on-chain ones. So Grove and Steakhouse and Sky have a big contingent of USDS. you see players like Athena coming in with them saying they're going to start diversifying out. Obviously, there's Tether, Circle, the large stablecoin issuers. I really think those are probably the biggest allocators today. Where I do see it going is folks like yourself who have some traditional skill set as well as been in digital assets for some time. To what Conor's saying, starting these specific vehicles, targeting these kinds of assets, because it doesn't fit the pools of capital that crypto has raised till date. And I think it's just further sophistication of the players and the capital allocators in the space.
So what's the criteria and the thresholds? You know, if you give me kind of your top two, what are the things that you're saying the most?
I think it's Lorian said it really well from Figment earlier, but qualified custody, having actual legitimate, we're US based, having legitimate pathways for a US based institution to allocate. It also just, there's a maturity level that certain folks who are trying to target capital allocators need to know some of the basics, and sometimes that's not even being met. And so I think that I spend a lot of time having to explain what oracles are, what qualified custody is, what the need for all these pieces of the stack are for an on-chain morpho lending market to exist for us to create.
Shanlong, what's kind of the institutional pitch for XDC and the projects that you've invested in?
Yep. Okay, so for XDC itself, I think we usually adopt a more cautious approach. So we usually invest in RWA or finance RWA projects which have the necessary licenses either in US or other jurisdictions like in Singapore itself. Because I think we feel that at the end of the day, trust is one of the most important factors in the space itself. So hence, like going back to my original example of compute labs as well as their vaults, for institutions, we also wanted to layer on insurance as well, because we do understand that even though the APY is lower itself, but it is something which institutions are on the lookout for, because like trust is very important to them. And sometimes when you're actually talking to institutions, sometimes less is actually more, because higher yields and so on might actually just lead someone to freak out that the team is actually too degen per se, but sometimes they're on the lookout for something which is sustainable. Yeah.
Edwin, what is the pitch for Brickken for institutions thinking about, say, issuing new assets?
Yeah, so we actually pitch a lot of the utility factor, because we're now in an interconnected economy at the speed of light, actually, and they can start doing collateralization. There's a lot of products out there that are very static, right? We come from a paper written by lawyers that if you want to do a refinance, everything takes a lot of months to do a lot of things in the back, and now you literally can just plug and play everything. Like you have a finance instrument out there, and if you have good yield, maybe you can plug and play into some vault that is now doing RWA, and that's just crazy. And actually, in Europe, we have a Barcelona. We're based in Barcelona. They're a little worried about, because there's a loophole about funds. You can start like the vault is a fund now. And they're like saying, what's happening here? Because the structure of the conventional structure is a locks fund under a fund admin who's giving you the block to become a fund manager. And then suddenly these vaults are popping everywhere. And they're like, yeah, but how is it whitelisted? Is it accredited? And then they're like, no, but we're doing this loophole and this loophole. And just saying, like, what is the institutional pitch is like, right now it's a great opportunity to start testing all of this, because I think the early comers are going to provide or get a better yield than in the future when the volume just becomes too massive. And I think that's what we always pitch is like, just if you want to be static, stay in your house. If you want to be dynamic, come to the blockchain.
Thanks for that. We have come to the moment of the speed round. We're going to close things up, gentlemen. What in the next 12 months should RWA really be getting right to make this thing all work? What's the one thing you each think? I'll start with Edwin.
Oh, yeah. Distribution. We need good layers of liquidity, and we need to have the distribution layers very well made. I think we don't need more tokenization as a service company, even though I'm one, but I'm saying like the fact of the supply, it's already well done. And now the next layer is like, if I was starting a startup right now or a company, I will definitely go into the distribution layer, because you already have an oversupply and you now have to generate the demand. And that's when we're going to have a huge market of tokenized assets. So right now the opportunity is in somebody fixing the distribution layer and then the liquidity.
We all need downstream, right?
Yeah.
Yeah.
Okay, so for myself, I agree with him. I think the first one most important, is liquidity. it's pointless to have $1 billion, $1 trillion worth of RWA when there's no liquidity there. And of course, the next thing would be in terms of recourse itself. Like it's all very good when you talk about like attractive like APYs and so on, but at the end of the day, when shit actually hits the fan, like what is your legal like recourse itself? Like is it even worth the while going through all the legal fees, like based on what you had invested in? So I think this, like to this extent, I think there needs to be more transparency.
Yeah, that's a horse pulling the cart, right? Yeah. Bhavin?
I think I'm going to piggyback on liquidity, but it's a little different take. It's
That's the cart.
atomicity of these assets. So when in our morpho markets, when you lever up an RWA asset and someone wants to unwind said leverage before a quarterly redemption, someone needs to hold that risk. It doesn't just go away. And so that's been a real problem that I see a lot of folks trying to solve. And I think in the next 12 months, I expect a lot of headway to be made there.
Everyone else is talking about the supply side, so I think just more types of assets tokenized on-chain available. Like you said, it's really just T-bills and 5 other companies. So I'd love to see a lot of diversity there and diversity in like things that would be interesting to ultimately for that capital on-chain to be able to pick and choose different yield opportunities, and that's where I would like to see it grow.
That's great. Everybody, let's give a round of applause to Conor, Bhavin, Shanlong, and Edwin. Thanks, guys. It was great. Thank you.
Thank you.
Thank you.